Welcome to the deep dive. Today, we are taking a really specialized look, a deep look, I should say, into the inner workings of institutional trading.
Yeah, this is some dense material.
It is. We're diving specifically into the core curriculum of the Inner Circle Traders 2016 Mentorship Month '04, to be exact. And our goal here, it's not just to, define a bunch of terms.
No, not at all. It's about integration.
Exactly. Connecting the macro drivers that validate a trade with the microstructures you need to actually execute it, we're looking for that signature of smart money.
The high probability, low resistance stuff. And this month, this is really where it all comes together. We're bridging the macroeconomic why what fundamentally drives currencies with the technical how.
Things like order blocks and fair value gaps.
Right. But before we even get into the charts, we have to put up the disclaimer. It's vital. These are advanced concepts, so under CFTC Rule 4.41, remember that hypothetical results have limitations. They are not actual trading.
And the risk in live markets is substantial. Nothing we discuss here is investment advice.
Okay, got that out of the way.
Good. Now, let's jump straight in. I mean, if we strip away all the news, all the indicators, all the noise, where does the real movement in the market, especially currencies, even start?
It's one place. The source material is very clear on this. It's interest rates. Full stop. They are the single most influential driving force.
It's something retail traders just don't look at enough.
They don't. They look at the currency pair in a vacuum.
Well,
But professionals, they are watching the bond markets like a hawk.
right.
If you don't understand the shifts in interest rates, you can't establish a non-negotiable bias.
So even if a technical setup looks perfect on a chart,
If the interest rate foundation isn't there to support it, smart money simply won't step in. They won't push it.
Okay, so we need a framework for analyzing these rates, and that brings us to what the material calls the interest rate triad. What are the three instruments we're always comparing?
It's the three key benchmark treasuries. You have
Yeah.
the 30-year bond, that's your long-term rate, then the 10-year note for your intermediate view, and the 5-year note for the short term. It's the comparison across these three that gives you a visual read on what's really happening.
Accumulation or distribution at the highest level.
Exactly. It's like detective work, as you said. You're looking for an institutional fingerprint, a divergence within the triad itself.
So let's use an example. Let's say the US dollar index is hitting a deep discount, maybe an order block, and it looks like it's setting up for a big rally. How does the triad confirm this isn't just, a temporary bounce?
It confirms it through something called a failure swing. So let's say you see two of the notes, maybe the 30-year and the 10-year make comparable lows.
Okay.
But the 5-year note, which is the most sensitive, it fails to make a lower low. That divergence is a massive signal.
What's it telling us?
It's telling you that foundational buying pressure is stepping in, preventing that full discount from being hit. That failure swing is your validation that smart money is participating. They're supporting the dollar move you're expecting.
That's fascinating. You have to look completely away from the chart you're trading.
You have to.
So on the flip side, what does distribution, a bearish signal, look like?
So for distribution, you might see the base asset, say the dollar, making higher highs. It looks strong,
Right, retail is buying that?
of course. But if you look at the triad and see that two of its elements are making lower highs, that means there's heavy selling hidden inside that rally. Smart money is using the retail excitement to unload their positions. It's a classic setup for a move lower.
Okay, so the triad gives us the fundamental direction. Now let's talk about how they engineer the perfect price to get their orders filled. This brings us to liquidity traps.
This is the heart of it. If the triad is the direction, liquidity is the precise execution price. And the big mindset shift here is that retail traders use indicators to find out where to enter.
Whereas smart money.
Smart money uses indicators to figure out where the orders of the masses are sitting. That's the fuel.
And the fuel is the buy stops above old highs and the sell stops below old lows. The external range liquidity pools.
Exactly. Think of it like a gas station. If smart money wants to place a massive buy order, they can't just click a button. They need someone selling to them at a discount.
So they run the price down.
They run it below an obvious old low, which triggers all those sell stops from breakout traders and nervous holders. And what do? They buy all those stops cheap. That's your stop hunt.
But here's the trap. The sources warn that divergence, which is a classic retail signal, is often a setup, the phantom trap. Why is the common type 1 divergence so dangerous?
Because that type 1 divergence, price makes a higher high, but your RSI or stochastic makes a lower high. It creates a consensus.
A belief that the market is topping out.
Right. So retail traders see that and they sell. Smart money knows they're going to sell. So what do? They push the price just a little bit higher, trigger all the stops sitting above that high, grab the liquidity they need, then they reverse the market.
They use the retail expectation against them.
Every single time. It's a necessary cleansing move. But the real insight, the counterintuitive part, is the type 2 hidden divergence.
And why is that one so important for trend continuation?
Type 2 is a huge confirmation of institutional trend following. Let's say we're in a bullish trend. Price makes a higher low, but your momentum indicator makes a lower low.
So it looks like momentum is weakening.
Right, which scares retail out. They exit or they try to short it. But a smart money trader sees that higher low in price holding firm despite the weak momentum. And they see that as immense buying pressure. The trend is about to accelerate.
Okay, so if we anticipate one of those stop runs, say below an old low in a bullish market, the material gives a very precise entry detail.
It does. You'd place a buy limit right at or just below that old low. You're anticipating a shallow sweep, maybe 10 to 20 pips. You are literally buying the sell stops.
And risk management.
Key. A 30 to 50 pip stop loss is usually enough. If price blows through that 50 pip cushion, your initial read was just wrong. The bias is probably invalid.
All right, so we've covered the external targets. Now let's shift to the internal delivery. The market often leaves behind gaps when it moves fast. And this is where we get tools like the fair value gap and the order block.
We're moving from the macro validation down to the micro precision of execution. And the order block is really the primary entry signal. It represents the last level of professional accumulation or distribution right before a huge expansion.
Let's nail down the technical definition of a bullish order block.
Okay, a bullish order block is the lowest down close candle or price bar with the most range, and you'll find it near a support level. But that's not enough.
You need validation.
You need validation. The high of that down close candle must be traded through by a later candle. We call that displacement. That sudden energetic move is the institutional signature.
So displacement is the green light. And when price returns to that order block, that's our entry. What's the tightest way to manage risk on that entry?
Well, the entry is often the high of the order block. Your stop can go below the low of the candle. That's safe. But for a tighter, more aggressive stop, you place it just below the mean threshold.
Which is the 50% midpoint of the order block's body.
Exactly. The logic is if the institutions can't even defend the midpoint of their own block, the trade is probably busted.
Makes sense. Now let's touch on those gaps left behind. The fair value gap, or FVG. Can you simplify that definition? It can seem a bit dense.
Absolutely. It's a simple three-candle pattern, an imbalance. In a down move, you have candle 1, then a big down candle, that's candle 2, and then candle 3. The FVG is the space between the low of candle 1 and the high of candle 3.
A space where only one side of the market was offered.
Exactly. Only sell-side liquidity. The market hates that inefficiency, so it tends to revisit that gap to fill it in and offer two-sided liquidity. It's like a magnet for price.
And that's related to the liquidity void, which is even more aggressive, right?
Right. A liquidity void is just a series of those long, wide, one-sided candles.
Yeah.
It happens during extreme displacement. It's porous. There's no contrarian orders in there. Price almost always comes back to fill that area in.
It's a vacuum.
A total vacuum, which leads to the vacuum block. This often happens after a big news event, like NFP, creating a breakaway gap.
And the institutional bias there?
Is to close it. When price returns to that vacuum, it often seeks to close it perfectly, to the tick. And once that gap is closed, the level that closed it becomes a very strong reference point. Price shouldn't need to go back there.
Okay, one more structure before we put it all together. Rejection blocks. These deal with turning points that aren't clean stop hunts.
Rejection blocks are all about focusing on candle bodies over the wicks. So a bearish rejection block, you'll find it at a swing high with these long wicks sticking up. The block itself is defined by the highest point of the wick, down to the highest open or close, the highest point of the candle's body.
So the move is just a quick poke above the body to clear immediate buy-side liquidity and then an aggressive rejection.
Exactly. And you then treat that zone, that range, as a bearish order block if price returns to it. The key action happened around the body, not the whole wick. The bullish rejection block is just the inverse of that.
Got it. Okay, this is a ton of information. The hardest part is integrating it. What is the mandatory validation flow? The sequence someone has to follow.
This is critical. Step 1, determine your directional bias. Look at the monthly, the weekly, and the daily charts.
High time frame first.
Always. Step 2, identify your focus point on the chart. Is it an order block, an FEG, a liquidity pool? That's your technical setup.
And then the crucial third step, the one that connects everything back.
Validation. You have to, and I mean immediately, refer to the interest rate triad and the US dollar
Yeah.
index. You're looking for that divergence confirmation.
The failure swing we talked about.
That's the one. If the triad structure supports the dollar move that your technical setup is pointing to, that is your green light. It validates that institutional money is flowing in your direction. If that confirmation is missing,
You pass on the trade.
you pass. It's what separates high probability trading from just reading patterns.
So for someone learning this, what's the best way to practice? What's the homework?
Historical analysis. It's the only way. We'd suggest you go back and review charts like USD-JPY or your USD around major dollar rallies. The one leading into late 2016 that the mentorship covered is a perfect example.
And what should they be mapping out specifically?
3 things. First, find the exact interest rate triad divergence that kicked off the move to dollar strength. Second, find the specific bullish order block the dollar index hit to launch that move. The 99.50 level mentioned in the source is a good place to start.
Okay.
And third, follow the foreign currency pair, like Euro USD, and watch how it then moves to target an obvious old low, like the 108.65 level. You have to do that integrated practice to make it second nature.
This brings us completely full circle. We've gone from the macro driver, the interest rate triads, all the way down to the precise execution structures.
Exactly. And the big takeaway is that the market is not random. These concepts show that large institutions must operate in a predictable, repeatable way because of their size. They can't hide their footprints.
They leave these massive readable signatures on the chart.
They have to.
So here's a final provocative thought for you to chew on this week. If classical indicators and retail patterns only measure what's already happened, consider the implication that the market structure doesn't just ignore those retail beliefs. It actively uses them. It engineers a type 1 divergence specifically to create the liquidity it needs to move in the direction validated by the bond market. So maybe you should focus less on what you think should happen and far more on where the necessary orders must reside.